Something is happening in the global financial system that most American investors are completely ignoring. Central banks around the world, the institutions that control national currencies and monetary policy, are buying gold at the fastest pace since 1950. Over 1,000 tons per year. And they are not stopping. When the people who print money decide to buy gold, that is not a coincidence. That is a signal. And understanding what that signal means for your money is exactly what we're going to do in the next 10 minutes. Let's start with the numbers, because they are stunning. In 2022, central banks globally bought 1,136 tons of gold, the highest annual total in recorded history. In 2023, they bought 1,037 tons, the second highest year ever. In 2024 and into 2025, the pace continued. We are in the middle of a sustained, multi-year wave of central bank gold accumulation unlike anything seen in 7 decades. Who is buying? China's People's Bank of China has been adding to its gold reserves every single month since late 2022. India's Reserve Bank purchased over 100 tons in 2024 alone, more than double its typical annual pace. Poland, Turkey, the Czech Republic, Singapore, Qatar, central banks across Asia, Eastern Europe, and the Middle East are systematically moving reserves from dollars and U.S. Treasury bonds into physical gold. This is not an accident. And to understand why it's happening, you need to understand one event that changed everything. In February 2022, the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. Overnight, assets that Russia believed it owned, sovereign reserves, the property of a nation-state, became inaccessible. They were locked, seized, used as leverage. Every central bank in the world watched this happen. And every central bank in the world asked the same question: if this can happen to Russia, can it happen to us? The answer they arrived at was yes. And the logical response was to move reserves out of dollar-denominated assets, U.S. Treasury bonds, bank deposits in Western institutions, and into something that cannot be frozen, cannot be sanctioned, and cannot be controlled by any foreign government. Physical gold, held in your own country's vaults, is immune to sanctions. It cannot be frozen by Washington. It cannot be seized by Brussels. It is outside the reach of swift exclusions and executive orders. For central banks that felt exposed by the Russia event, gold became the obvious hedge. This is called de-dollarization. And it is not a fringe theory. It is documented in the quarterly reports of the World Gold Council, in central bank reserve disclosures, and in the purchasing data that comes directly from these institutions. Now here's what this means for the price of gold and for your portfolio. Supply of gold is constrained. New gold mining adds roughly 3,500 tons to global supply each year. That number has barely changed in a decade. The Earth doesn't produce more gold just because demand increases. When a new buyer of 1,000 tons per year enters the market and does not leave, the price math is straightforward. Gold hit $2,000 per ounce in 2023. It crossed $2,500 in 2024. It has been setting new all-time highs repeatedly, not because of panic or speculation, but because of steady, institutional, central bank demand that has no sign of slowing. There is also a broader signal embedded in central bank behavior. When the institutions that manage national currencies start moving away from currencies and into gold, they are expressing a view about the long-term stability of the dollar-based financial system. They are not doing this publicly. They are not announcing a crisis. They are just quietly moving their reserves. And the direction they're moving tells you something about what they expect. What does this mean for the average American investor? Most financial advisors suggest allocating 5 to 10% of a portfolio to gold as a hedge against inflation, currency debasement, and systemic financial risk. This is not a new idea. But the case for that allocation is stronger today than it has been in decades. Here's why. The dollar's purchasing power has declined over 40% in the last 10 years. Real interest rates, after adjusting for inflation, have been negative or near zero for most of that period. The U.S. national debt has crossed $36 trillion and is growing faster than GDP. None of these trends are reversing. And gold historically performs best precisely in environments of monetary stress, high debt, and dollar weakness. The argument against gold is that it produces no income, no dividends, no interest. That's true. But in a world where the institutions that issue currency are hedging against their own currencies, that argument becomes less compelling. 3 ways to get exposure to gold, each with different risk and return profiles. Move 1: Physical gold. Coins in bars held directly. American Gold Eagles, Canadian Maple Leafs, gold bars from recognized refiners. Physical gold eliminates counterparty risk. You own it outright. The downside: storage costs, insurance, and lower liquidity than financial instruments. This is the form central banks are buying, the pure, unencumbered asset. Move 2: Gold ETFs. Funds like GLD and IAU hold physical gold and track its price with low fees. IAU charges 0.25% annually, a small cost for liquid, easily tradable gold exposure. Gold ETFs are appropriate for investors who want the price exposure without the logistics of storage. They are not perfect, they are financial instruments, not physical metal, but for most individual investors, they are the most practical entry point. Move 3: Gold mining stocks. Companies like Newmont, Barrick Gold, and Agnico Eagle. When gold prices rise, mining companies can see earnings expand significantly because their production costs are fixed while their revenue rises with the gold price. Mining stocks carry more risk than physical gold: company-specific risks, operational risk, geopolitical risk in mining regions, but they also offer leverage to gold's price movement. When gold runs, well-run miners can outperform it. The key point is this: owning zero gold when central banks are buying at a 70-year record pace is a choice. It's a choice to stay fully exposed to dollar-denominated assets in a world where the institutions that manage those assets are quietly diversifying away from them. Finance Alert Global tracks these signals, the moves that institutional money makes before they become mainstream news. Subscribe now. The central banks started buying in 2022. Most Americans still don't know it's happening. That window won't stay open forever. Subscribe. I'll see you in the next alert.